So you want to buy an apartment building, or you're in the process of doing it, or maybe you already own one. Today, I'm going to give you 10 mistakes to avoid when buying your first multifamily property, or even if you have it now, maybe you can identify some things you're doing wrong and correct them. And some of these 10 items are mistakes I personally made that I was able to adjust very quickly and had a much easier time with my second building. So let's get into it. If you don't know who I am, my name is Aaron. I'm a real estate agent here in the Chicagoland area. I own 2 apartment buildings. There's 7 units, and we're in the process of buying 30 doors as we speak. That being said, a lot of these mistakes I'm going to share with you are mistakes that I personally made and I learned from and had a better experience on my second property. So let's get into it. Number 1, I can't believe I made this one, not accounting for vacancy. I figured I was buying, 7-unit buildings that's very easy to make sure that 7 units are 100% occupied 100% of the time. But unfortunately, they're not. There's, turnover periods, there's tenants moving out early, there's rent not being paid. There's a lot of issues that could come up, and when you don't account for vacancy, you do your numbers in a way where it's like, oh, in a perfect world, the deal makes X amount of money and you get excited and you pay a certain price based on that X amount of money. But once you start accounting for vacancy, that's when you can give a more educated offer and a safer offer so you're not risking your ass paying way too much for any type of property. Moving on to number 2, not including property management in your numbers. Again, I was personally gonna manage both these buildings, so I said, why do I need to account for property management? But here's the reality of the situation. If you're gonna invest in real estate as your business, and if the deal does not have room for property management and still kick off a profit, that's not a good deal. Because at some point, either you gotta be paid for your time, or you have to give somebody else the money so that they can manage your buildings so you could continue focusing on growth. So if you need to account for property management when you're buying any rental property, even if you're gonna manage it yourself. Number 3 is a mistake I definitely made, but there's no way I would have known to avoid it, which is underestimating operating expenses. I looked at what the previous seller was paying and I assumed that's how much my bill would be, but I really didn't account for, hey, my operating expenses could go up based on how many things break and how many times it snows in a month. And we're in Chicago. It snows 6 times in a month. That's an extra $800 I have to spend that month. And how much is my gas bill gonna be? Like, I didn't quite understand how expensive it would be on the operating side, because obviously when you're buying a building, oftentimes the sellers are grandfathered in certain pricing, like their insurance is gonna be cheaper, or maybe they're doing their own snow removal and you may not be able to do that. So always build in a little bit of a cushion for operating expenses for yourself. The 4th mistake you want to definitely avoid is keeping your rents too low. This is definitely a mistake I made with my first building. I raised everyone's rent to $1,000. In, retrospect, whatever the word is, it should have been $1,100. So therefore, when I bought my second building, it was pretty much identical buildings, I raised it to $1,100 and I was able to get that rent because I've done my market research and I know that I'm still below market at that price, but it's a lot more profitable for me. So simply by keeping my rents too low, I am actively losing, I believe, $500 a month because of the 5 tenants that are grandfathered in at that lower rent. So make sure you're doing your research and you keep those rents where it makes sense for you. This is a business, which leads me on to number 5, big mistake. I made this mistake. Let me get intimate with you. Let me move my videographer's jacket here. Getting too personal with your tenants. This is a business. I want you to think of your tenants kind of like they're your customers, they're not your best friends, right? You are trying to operate a business, you have a product or service that you sell, and they are purchasing your product and service, right? And that is where it starts and ends, period, the end. On my first building, I decided, I want to be very personal. I want to go meet every single tenant one by one, introduce myself, explain how to blah, blah, blah. Waste of time, because now I'm too available. They always message me when they need something, and they have my personal cell phone number. So not a good way to go. Second building, I said, you know what? I'm going to just be the property manager. I'm going to send out an email and then have a set system. If they have a question, they can send it to this email. They don't need to meet me. They don't need to know my life story. Boom. And I've had a much easier time managing my second building because that simple change in my approach. The 6th mistake you definitely want to avoid is not having service partners. What do service partners mean? That means you have a go-to plumber you call, you have a go-to HVAC person you call, a go-to handyman you call. Here's why. Because When shit hits the fan, when things break, they never break on convenient terms. And the things that break are not the things that are, you could fix anytime you want. It's always time sensitive. Like your heat breaks on the coldest day, right? So I'll give you my example. My heat broke on Christmas Eve at 5:42 in the morning. Christmas Eve, -2 degrees outside, tenants have no heat. So what do? I drive out there and I unlock the boiler room, right? I drive out there, see if I could fix it on my own, see if it was a simple issue of like, the boiler needed to be turned on and off. It wasn't. So what I I left. I called my service partners because I have a plumbing and HVAC company that I mainly go to. They've been managing these buildings when the previous owners owned them, and they're gonna manage them while I own them because they know it better than anybody else, right? So I called them, their emergency hotline, and because I was a previous customer and I paid them a good amount of money, they came out that day and fixed my heat. Not a lot of people would be able to do that on such short notice, and you want to make sure that you have these partnerships in place so you have somebody to call when shit hits the fan. Because if you don't, then the property management side of things becomes a lot more difficult. Now, obviously, if you have property management handling it, they have people, they'll call and you'll get billed for it. Simple. Number 7 is a catastrophic mistake that you absolutely must avoid, and this is where a lot of investors go into foreclosure, lose their properties, get out of real estate, and it's simply by not having enough working capital. What does that mean? That means, okay, let's say you're buying $1 million property, you need $250,000 to buy the deal, right? That doesn't mean you just have $250,000. You could go buy, $1 million property, because then you have no other money for renovations, vacancy, property management, for things going wrong, for evictions, and very quickly you become dependent on your monthly rents, your cash flow, right? And you either start living off it, that cash flow is literally feeding some of the holes, and you get into a lot of trouble because now, when your tenants threaten to leave, you literally can't afford a month of vacancy, which means you start bending the rules of how you run things, and very quickly you completely lose control of the asylum, and you have a miserable experience owning real estate. Vice versa, this is one mistake I will gladly say I did not make because I'm a very cautious guy. I don't like to take a lot of risks. I had 260 to work with. I put 180 into purchasing the deal and had $80,000 in working capital for renovations, vacancies, issues that come up, repairs on Christmas Eve, and that will save your ass time and time again. So make sure you have tremendous amount in working capital. Number 8, this is a simple one. Over improving the property. You need to really understand, what do tenants care about? For example, if your rents are $1,200, $1,300, you do not need to make that place looking like the Taj Mahal, okay? It just needs to be clean, solid built, and easy to move in. Simple as that. You don't need the top of the line, mahogany floors. You don't need hardwood floors. You don't need like incredible countertops. No. You don't want to go too cheap, but at the same time, you don't want to get too crazy, right? And always ask yourself, if I do this, how much will my rents increase? For example, let's say you need to remodel a kitchen, and if you remodel it, you can get $1,300. If you don't remodel it, you could get like $1,150. And remodel is going to cost you $8,000. You say, okay, if I remodel, it's going to take me 7 years to get my $8,000 out. Is that worth the investment for me? If it is, do it. If it's not, don't do it. So always have that conversation with yourself. Number 9 is hiring cheap labor, which kind of goes in hand with having a lot of vacancy, not having working capital. Oftentimes, people who do hire cheap labor are the ones who don't have a lot of capital to work with. And what happens when you hire cheap labor is they disappear on you as soon as they find someone that pays them more. They're not reliable, they're not consistent, and the work is very shoddy, which means you're gonna have to do it over and over again, and it's not gonna be reliable, right? So do not fall for the trap of hiring a cheap contractor. Go with somebody that you worked with in the past that you know could deliver results and is not gonna take 8 weeks to renovate a small condo. They could be in and out in 2 to 4 weeks doing certain repairs. That way you don't have 2-3 months of vacancy because nobody can afford that. And finally, this is the nail in the coffin. This right here, if you don't have this before you even buy, you're in some shit. Your exit strategy. When you're buying multifamily real estate, apartment buildings, we're talking about commercial grade, you really gotta treat it like a business. If you're just buying it without really knowing where you're gonna end up, then you don't know what decisions to make. You don't know what renovations you need to do because, for example, I made earlier, $8,000 may only increase your rents $150, right? However, it may increase the value of your building by $30,000 when you go to sell. So if your exit strategy is to refinance and sell in 3 to 5 years, it might make more sense for you to redo those kitchens, right? If your exit strategy is just to hold on to it forever and have the lowest vacancy possible, It may actually make sense for you to keep your rents low so tenants never move, right? Knowing your exit strategy before you buy is a critical part of the entire journey, right? From the beginning, you must know where you want to go. That way you gotta go south, west, east, north. I don't know what directions I'm pointing at, but that's it. Those are 10 mistakes you must avoid as a brand new real estate investor buying your first apartment building. I don't know how many apartment buildings you're having. If you're making these mistakes, please avoid them. And let me tell you, there's 10 mistakes on that list. I made about 4 to 6 of them all day, every day on my first building. And I learned from them, and I hope this video allows you to not make those mistakes, not lose that money, and not have the vacancy, and get the job done right the first time, and have a merry experience with real estate investing and build wealth. If you enjoyed this video, like, comment, subscribe. I got 2 products for you in the description. If you want a 1-hour coaching call with me, there's a link in the description for that. And if you would like to join the Patreon, where I do a weekly Q&A every Thursday at 10 a.m. Central, feel free to click the link below as well. That being said, I'll see you in the next video. Like, comment, subscribe.